If you've bought literally anything recently, you already know the global supply chain is under immense pressure. Welcome to this explainer. Today, we're diving deep into Global Ship Lease's Q1 2026 results to uncover exactly how a company maintains extreme profitability in the middle of what can only be described as unprecedented global shipping chaos. Honestly, as we unpack this today, you're going to see a total masterclass in strategic insulation. Imagine, just for a second, trying to run a highly predictable, cash-flowing business when your primary global trade routes can literally vanish overnight because of geopolitical conflicts. I mean, it sounds totally impossible, right? The shipping industry is notoriously cyclical. It's constantly getting battered by shifting trade patterns, unexpected tariffs, and wildly unpredictable demand. And yet, Global Ship Lease, or GSL, has managed to build an absolute fortress. So the question we're answering today is how? Well, to really grasp their strategy, we first need to understand the macro environment. And right now, it's a massive storm. The Red Sea and Suez Canal diversions are forcing vessels to reroute entirely around Africa. That effectively absorbs about 10% of the world's total shipping supply. Keep in mind, normally around 20% of all containerized trade volume moves right through the Red Sea. Add to that the Strait of Hormuz being in a state of limbo, which is another 3 to 4% of container trade, and major regional ports suspending operations entirely. When 10% of the world's shipping supply is suddenly absorbed by longer transit times, spot market rates, the daily going cost to ship a container, absolutely skyrocket. It is a logistical nightmare for the world, but as you'll see, it's a highly manageable reality for GSL. Here's the roadmap for this explainer. 1. Navigating chaos. 2. The billion-dollar safety net. 3. Mastering the mid-size market. 4. Q1 2026 financial snapshot. And 5. De-risking the balance sheet. Section 1. Navigating chaos. Anchoring against storms. So how exactly does GSL anchor itself? Well, take a look at this staggering number, $2.1 billion. While the spot market violently fluctuates day by day based on whatever the latest headline is, GSL radically insulates itself. They've secured a massive $2.1 billion in forward contracted revenues. This means that regardless of what happens to daily freight rates, their revenue stream is completely locked in. Think about that for a second. In an industry that's literally defined by turbulent uncertainty, they've engineered mathematical certainty. They boast a 100% contract cover for the entirety of 2026. For 2027, they're already 86% covered. And across their entire fleet, they have an average remaining contract cover of 2.6 years. This isn't just weathering a storm, it's practically building a roof over the ocean. But seeing those massive numbers, you're probably wondering, who exactly is signing these multi-year contracts with GSL? Like, who is on the other side of that $2.1 billion handshake committing to lease these ships years in advance? Section 2. The billion-dollar safety net. Top-tier charterers. As it turns out, the biggest shipping players in the world rely entirely on GSL's fleet. MSC makes up 29% of their contracted revenues. They're followed closely by Hapag-Lloyd and Maersk at 19% each, and CMA-CGM at 15%. Look, these aren't just random companies. These are the absolute titans of global logistics. Think of them as the FedEx and UPS of the oceans. The fact that they secure multi-year charters with GSL speaks volumes about just how absolutely necessary GSL's assets are to global trade operations. Section 3. Mastering the mid-size market. Flexible and lucrative. Why do these giants rely heavily on GSL? It all comes down to fleet strategy. The media absolutely loves to focus on the massive 10,000-plus TEU megaships. By the way, TEU just stands for 20-foot equivalent unit. It's the standard shipping container you see on trains and trucks. But those megaships on arterial routes, they only account for about 25% of global containerized volume. GSL strategically dominates the sub-10,000 TEU market. These mid-sized ships serve the non-mainlane trades, which actually make up a whopping 75% of global containerized volume. GSL targets the quiet, massive majority of the market that's inherently way less dependent on single choke points like the Suez Canal. These mid-sized, highly flexible ships are the true workhorses of global trade. A lot of them are high reefer, meaning they carry lucrative refrigerated cargo. But more importantly, while the megaships are kind of like massive freight trains stuck on main railways, GSL's mid-sized ships are like nimble delivery trucks. They can navigate countless smaller regional ports where the giants literally cannot fit. This extreme flexibility is exactly why Maersk and MSC are so eager to charter GSL's vessels.
Section 4, Q1 2026 Financial Snapshot. A strong snapshot.
So, how did this brilliant combination of multi-year contracts and a hyper-focused fleet strategy translate to the bottom line? The results are incredibly strong. We're talking $198.1 million in revenue. Adjusted EBITDA, which is a really great measure of their core operational profitability, climbed to $133.2 million. Now, you might notice the $91.4 million net income looks slightly lower than Q1 2025's $121 million. But it's super important to note that 2025 included a massive one-time $28.5 million gain from selling vessels. When you normalize the earnings, the core cash-generating engine of this business is running exceptionally hot.
Section 5. De-risking the balance sheet. Bulletproofing the firm. Generating cash is great, sure, but capital allocation is where great companies really pull ahead. They are aggressively bulletproofing the business. They've paid down gross debt to $657.8 million while sitting on an enormous cash stockpile of $655 million. But honestly, here's the most staggering detail. They maintain a remarkably low 4.83% blended cost of debt. How did they pull that off? They brilliantly secured 0.64% interest rate caps on the secured overnight financing rate, which is the benchmark for floating debt. So in a world where high interest rates are just crushing other businesses, GSL has effectively neutralized the threat.
In capital-intensive industries, companies usually just hoard cash during the good times out of fear of the bad times. But because GSL is so aggressively de-risked, they're doing the exact opposite. They're maintaining a highly attractive $2.50 annualized dividend per common share. On top of that, they're actively executing an opportunistic share buyback program, having already repurchased $57 million in stock. As the source material points out, their model makes it exponentially easier for an investor to participate in this lucrative market through GSL shares, rather than, trying to buy and lease physical ships yourself. We've seen how geopolitical conflicts and trade route diversions have completely thrown the global logistics network into absolute chaos. Yet, by dominating the critical mid-size market, neutralizing interest rate risks, and locking in multi-year revenues with the world's biggest shipping titans, GSL has built a true financial fortress. It leaves us with a fascinating thought, really. We can't predict the next global crisis, but can we invest in the companies built to withstand them? Is radical predictability the ultimate competitive advantage in an unpredictable world? Thanks for joining me on this explainer, and keep questioning how the businesses around us build resilience right into their very foundations.